Good day, everyone. Today, we will discuss at least five functions of accounting. Here are the learning objectives for this topic. 1. To understand the purpose and significance of key accounting functions such as recording, classifying, reporting, supporting decision making, and ensuring compliance within a business context. Accounting functions act like interconnected gears when recording, classifying, and reporting work together. They create a complete and reliable financial picture. Understanding these functions helps students recognize how businesses transform raw data into strategic insights and transparent operations. Each function plays a distinct role in safeguarding resources, tracking performance, and building trust among stakeholders. Decision-making support highlights accounting's proactive value, not just describing what happened, but guiding what should happen next. Legal compliance through accounting isn't just about rules, it's about showing responsibility, credibility, and a commitment to ethical stewardship. 2. To remember the definitions and roles of each accounting function through examples and conceptual breakdowns that reinforce long-term retention. Learning the definitions of each accounting function is easier when anchored to real-life scenarios, like tracking expenses in a sari-sari store or analyzing a school's fundraising report. Breaking down each function into its core components, e.g., what it does, who uses it, and why it matters, helps students form mental hooks for retention. Repeated exposure to examples across different contexts, from small enterprises to global corporations, reinforces understanding and encourages transfer of knowledge. Using visuals like flowcharts or concept maps gives students a structured way to visualize how functions like recording, classifying, and reporting work together. When students can recall and relate functions to practical use, they build confidence, not just in memory but in applying accounting meaningfully beyond the classroom. 3. To apply these accounting functions to realistic scenarios, such as budgeting for a school project or managing a small enterprise, to demonstrate how accounting supports financial clarity and responsible decision-making. When students simulate budgeting for a school project, they actively use recording and classifying functions to track income sources, e.g. sponsorships, ticket sales, and expenses, e.g. materials, rentals, mirroring how businesses organize financial data. Applying the reporting function teaches learners to prepare simplified financial statements like cost breakdowns or profit summaries, which help teams assess whether their activities stayed within budget. Decision-making support becomes tangible as students evaluate which spending choices generated the most impact, encouraging reflection on cost effectiveness and resource prioritization. In managing a small enterprise, like a sari-sari store, students discover the importance of daily transaction logging and inventory tracking, key applications of recording and compliance that ensure sustainability. So, what are the functions of accounting? Number 1 is recording transactions. Accounting begins with meticulously recording every financial transaction a business makes: sales, purchases, expenses, and income. Every financial transaction, no matter how small, provides a piece of the story behind a business's operations. Sales show income streams while purchases highlight resource usage. Both are vital to understanding profitability. Even casual expenses, when tracked consistently, help reveal spending patterns and budgeting needs. Recording every movement of money creates transparency and helps prevent financial discrepancies. This logging forms the raw material that all other accounting functions build upon. This is done using journals and ledgers, following consistent and systematic processes. Journals act as the chronological diary of financial events, while ledgers group these entries into specific accounts. Consistency ensures that financial records are not just accurate but easy to interpret and audit. A systematic process avoids confusion, especially when dealing with high volumes of transactions. These tools give structure to what could otherwise become a chaotic pile of receipts and invoices. Over time, Well-maintained journals and ledgers help uncover financial trends and patterns. Accurate record keeping ensures that financial data is complete, traceable, and ready for further analysis. Completeness means no transaction is left behind, critical for fairness and reliability in reporting. Accuracy keeps figures aligned with reality, reducing risks of misstatements or fraud. Traceability allows stakeholders to verify records, following each number to its source. It also helps in reconciling bank accounts and reviewing financial behavior over time. This level of integrity builds confidence among investors, managers, and auditors alike. It forms the foundation of financial reporting, where one small error could cascade into major misstatements later. Without precise records, financial statements would become misleading or unreliable. Reporting builds on recorded data, summarizing performance for decision makers. Investors and regulators depend on these reports to evaluate financial health and compliance. Even internal planning and budgeting rely heavily on the accuracy of recorded transactions. Incomplete or inaccurate foundations can result in poor strategies or legal complications. Without this function, businesses would lose track of their financial activities and compromise accountability. A single missing or misstated transaction can distort profit calculations and cash flow tracking. Misstatements can affect tax filings, leading to penalties or audits. Financial accountability breaks down when stakeholders can't rely on the records. Correcting recording errors often takes time and may require costly investigations. That's why precision in this foundational step is not optional, it's essential for trust and integrity. Number 2. Classifying and summarizing information. After transactions are recorded, they are organized into categories like assets, liabilities, equities, revenues, and expenses. Categorizing transactions helps simplify complex financial data into recognizable groups. Each category reflects a unique aspect of a business's financial health, like what it owes, earns, or spends. Without clear classification, financial reports would be disorganized and difficult to interpret. This process builds consistency across accounting records, making comparisons easier over time. Students can grasp the importance by applying categories to familiar contexts like personal savings, bills, and allowances. This classification helps in preparing meaningful summaries such as trial balances and ledger accounts. Trial balances help confirm that debits and credits are accurately recorded, ensuring balance across the books. Summarizing through ledger accounts offers a snapshot of account activity, essential for tracking trends. These summaries are key checkpoints before generating formal financial statements. Understanding summaries builds a foundation for recognizing errors and reconciling accounts. It empowers students to move beyond raw numbers into meaningful reports that reflect real financial behavior. Summarizing allows users to see the bigger picture of a business's financial performance over time. Summarized financial data reveals patterns, whether profits are growing, expenses are rising, or liabilities are increasing. Seeing performance trends helps businesses and individuals make strategic decisions and long-term plans. It encourages students to look past single transactions and focus on cumulative impact. Comparing summaries over months or years teaches the importance of sustained financial discipline. This bird's-eye view makes accounting a tool not just for management, but for future visioning. It's not just about putting numbers in the right boxes, it's about organizing chaos into clarity. Unstructured data is like puzzle pieces. Classification and summarization assemble them into a coherent picture. It makes financial information readable and usable for various audiences, including owners, managers, and investors. Clear information strengthens communication across departments and among stakeholders. It also supports automation and software use, since organized data can be more easily integrated into tools. When students see data transform into actionable insights, accounting becomes more than math, it becomes meaning. With proper classification and summarization, decision makers can pinpoint trends and abnormalities that need attention. By summarizing data regularly, anomalies like sudden expense spikes or unusual revenue drops become visible. Trends help forecast future performance and budget wisely based on past behavior. Spotting irregularities ensures financial integrity and can prevent fraud or mismanagement. Decision makers rely on these insights to adjust strategies, manage risks, and evaluate success. Teaching students to observe and question patterns trains their analytical minds for real-world decision-making. Number 3 is preparing financial statements and reports. Accounting compiles the classified data into formal financial statements like the income statement, balance sheet, and cash flow statement. Financial statements transform organized transaction data into structured reports that reflect business health. The income statement shows profitability by comparing revenues and expenses over a period. The balance sheet captures a snapshot of assets, liabilities, and equity at a specific point in time. The cash flow statement tracks how cash moves through operating, investing, and financing activities. Together, these statements offer a comprehensive view of financial performance and position. These reports provide structured insights into a company's profitability, financial position, and liquidity. These insights answer essential questions like, is the business making money? Does it owe more than it owns? Can it pay its short-term obligations? Profitability analysis helps assess whether products or services are financially sustainable. Financial position reveals the value of the business and its dependence on debt versus equity. Liquidity informs whether the company has enough cash or near-cash assets to meet its obligations. These insights guide strategic decisions like expansion, cost reduction, or seeking investment. Stakeholders, including owners, investors, lenders, and regulators, rely on these reports to make sound economic decisions. Owners use financial reports to monitor performance and set future goals. Investors evaluate risk and potential return before buying shares or investing capital. Lenders examine cash flow and debt levels before granting loans or extending credit. Regulators check for compliance with laws, accounting standards, and ethical practices. Each stakeholder depends on these documents for trust, transparency, and accountability. A well-prepared financial statement is not just compliant, it tells the story of how a company has managed its resources and obligations. Well-prepared reports narrate how a business allocates, earns, and controls its resources over time. They reflect the company's values, whether it prioritizes growth, sustainability, or conservatism. Beyond meeting technical standards, these reports help reveal a company's financial strategy. Trends and anomalies can show how well leadership responds to internal and external pressures. It's not just numbers, it's the story of how choices, risks, and outcomes shape the organization. It also becomes a reference point for future planning, benchmarking, and auditing. Historical financial reports offer benchmarks that future performance can be compared against. Forecasting and budgeting are grounded in the analysis of past trends and spending behavior. External auditors rely on these reports for examining accuracy, fairness, and compliance. Managers use prior data to plan initiatives, set targets, and allocate resources efficiently. Even classroom simulations can benefit from this function. Students learn to think like business strategists. Number 4 is supporting decision-making. Beyond compliance, accounting delivers the information necessary for strategic choices, such as expanding operations, setting budgets, or launching new products. Accounting doesn't just meet legal requirements, it provides the financial clarity needed for bold moves. When businesses consider launching a product or opening a new branch, they rely on financial forecasts shaped by accounting data. Budgeting decisions become more precise when rooted in historical expense patterns and projected revenues. Strategic growth demands risk assessment, And accounting helps quantify potential gains or losses. Without this function, business decisions would hinge on guesswork rather than grounded financial reasoning. Managers use financial data to assess profitability, evaluate cost efficiency, and minimize waste. Managers use accounting reports to measure how much profit each activity or product contributes. Detailed breakdowns reveal which departments or processes consume more resources than they generate. Identifying waste, whether from overspending, underutilized assets, or inefficient workflows, is crucial for sustainability. Cost efficiency analysis highlights where budgets can be trimmed without sacrificing quality. These insights empower managers to reallocate funds where they can make the biggest impact. By providing timely and relevant insights, accounting turns raw data into a decision-making compass. Raw numbers hold little meaning until accounting organizes and interprets them. Financial data becomes a navigational tool for identifying trends, projections, and strategic directions. Decisions made with data are more defensible, traceable, and aligned with company goals. Accounting transforms uncertainty into clarity by showing what outcomes are financially viable. This decision-making compass supports both day-to-day operations and long-term planning. It helps identify what's working and what's not, guiding businesses towards smarter growth. Accounting reveals successful strategies through patterns of profit, cost control, and cash flow stability. It also highlights weak spots, such as declining margins or rising debts, that require correction. Businesses can adjust marketing, operations, or pricing based on these performance indicators. Continuous monitoring keeps growth focused, avoiding reckless expansion or underinvestment. Smarter growth stems from understanding which levers to pull, and accounting shows where they are. Whether for small sari-sari stores or large corporations, this function makes the difference between trial and error and informed leadership. A sari-sari store owner might use basic recording to decide which items to restock or discontinue. Large corporations, meanwhile, apply complex financial models to decide on mergers, expansions, or investments. Whether simple or sophisticated, the decision-making function of accounting is universally relevant. It equips entrepreneurs with tools for survival and equips CEOs with insights for innovation. This broad application proves that accounting is not size-dependent, it's strategy-driven. Number 5 is ensuring legal and regulatory compliance. Accounting helps organizations comply with tax laws, corporate regulations, and reporting standards. Accurate accounting ensures that taxes are computed based on correct financial records, avoiding underpayment or overpayment. Timely filings demonstrate that a business respects government deadlines and maintains operational discipline. Organized documentation allows for a smooth audit process, saving time and reducing stress. Keeping records ready for inspection reflects transparency and readiness to cooperate with legal authorities. This function safeguards businesses from unexpected penalties due to disorganized or incomplete information. It ensures that taxes are calculated properly, filings are made on time, and documentation is available for audits. Accounting ensures companies follow national and international standards like IFRS or local tax codes. It provides frameworks for preparing reports that meet regulatory expectations and legal consistency. Compliance builds credibility with shareholders, government agencies, and the public. Understanding legal requirements through accounting creates a culture of accountability and informed management. Businesses that prioritize compliance are more resilient during policy changes or economic scrutiny. This function protects organizations from penalties, fines, or legal disputes. Mistakes in financial reporting or tax computation can lead to costly legal consequences. Reliable accounting reduces the risk of triggering investigations or lawsuits. Penalties for non-compliance can damage both finances and reputation, especially for small enterprises. Preventive accounting practices act like a financial shield against missteps and oversights. Organizations with strong compliance controls are seen as stable and trustworthy by regulators. It also builds public trust, showing that the business is operating transparently and ethically. Transparent reporting shows stakeholders that a business is not hiding its financial activities. Ethical accounting creates a positive image that attracts investors, partners, and customers. Inconsistent or opaque records raise doubts about integrity and responsibility. By being financially honest, companies contribute to a healthier economic and social environment. Trust earned through ethical accounting can be a long-term competitive advantage. In a fast-changing regulatory landscape, up-to-date accounting practices are key to staying on the right side of the law. Tax laws and reporting standards change frequently, and accounting ensures businesses stay current. Staying updated protects organizations from applying outdated rules that could lead to violations. It reflects agility in adapting to new compliance frameworks without disrupting operations. Accounting teams must continuously monitor changes and integrate them into their systems. Businesses that keep pace with regulatory updates show maturity and preparedness for the future.